So I'm going to be talking about the latest research that we've done in evaluating Ravenpack's new data set and looking at to what extent it adds value over the subscription that we currently subscribe to and whether that additional value warrants us from upgrading our subscription. Before I get started, I should probably mention that the views that I present here are not necessarily those of MSCI. They are of mine own, and anything I say can and probably will be used against me in my next bonus discussion. So with that said, let's get going. So what's better about and new and different with Ravenpack's new data? So I would summarize it in about three things. They have many more news sources, 19,000 versus 1 in our current subscription, so that's a pretty big difference. They've enhanced their event taxonomy and event detection algorithm, so that's pretty significant. And they've also added new data and metadata around novelty and relevance scoring. So we sought to understand what's the impact of these enhancements on some sort of basic sentiment signals that we constructed from their essential sort of sentiment scores. One is the event sentiment score called ESS, which is driven by sort of the type of event that they detect and also the magnitude of that event. And so we would expect intuitively that the improvements to their event detection algorithm and taxonomy would have a bigger impact on these ESS-derived signals. And we constructed also signals from their composite sentiment score, and we would expect that in general the impact from the greater news sources would have a larger impact on those signals. As I mentioned, we constructed some very basic type of signals, simple average, aggregated over a week, a month, or a quarter. Per Ravenpack's suggestion, we removed the neutral scores first before calculating these averages, and then just took an average over the days in the Lookback Window. We looked at it with and without relevance and novelty filtering, as specified there, also per Ravenpack's suggestions. And we also looked at another simple signal constructed from the sum of sentiment rather than average. So that sort of signal will put the companies with more volume of news and more extreme news into the tails. But before I get going, the results that I'll present will have a lot to do with, or I'll be showing a lot of data on what we call factor returns. So I'd like to take a minute to explain exactly what that is and basically explain what I call the MSCI way of looking at factors. So I think you're all probably familiar with the CAPM model. You have your asset returns, the market returns. You regress your asset returns on the market return and end up with a beta, which is your exposure of your asset to the market, how sensitive your asset is to the market returns. We can expand this to a multi-factor sense, and we can have factors derived from countries, from industries. In the simplest case, it would just be binary. Are you in this industry? Are you in this country or not? And we can also have factors derived from style factors like value, momentum, quality, dividend yield, the ones that we know and love so well. And all of these factor exposures we know at a given point in time. We know what the earnings yield is. We know what the trailing 12-month momentum is. We know whether the company is in this industry or that one. And so the thing that we are interested in solving for, though, is the factor return. So what is the return component of the asset's return that is driven by each individual factor? And we solve for that via a cross-sectional regression. So the academics love their time series Fama-French style regressions. At MSCI Barra, we love our cross-sectional regressions because that allows us to get the factor return, or what we sometimes refer to as pure factor return, because it's the factor return purely driven by that individual factor after you take out the effects from everything else, all the other industries, the countries, and all the other style factors. So that's what I mean by factor return. So in our US analysis, we use the latest generation of Barra US model, which we call US Fast. It has 24 different style factors in it. You know, the value, momentum, quality, yield, volatility, and size, and all those great ones that we know and love. Those are sort of the long horizon factors. It also has 5 other short or what we call medium-term horizon factors, most notably a sentiment factor that's a combination of analyst sentiment, news sentiment, and options sentiment. So when we did these cross-sectional regressions, we replaced that sentiment factor with the news sentiment factor of interest that we're analyzing, just so we don't have sort of double counting or 2 news sentiment factors in the model. And then there are other shorter term factors based on price movements as well and short interest. So we're basically accounting for a very wide range and fairly complete set of other style factors when we're doing these regressions. So the return attributed to the news sentiment factors that we're looking at is really is unique and orthogonal to everything else that we have. Just interesting to look at the cross-sectional correlations of the news sentiment factors that we analyzed with all the other factors in the model. You notice that they're all quite low, within plus minus 0.1 or so generally. And even the sentiment factor, which I would have expected to have the highest correlation, was still only around 0.05 or so. And that's probably driven by the fact that our sentiment factor is largely driven by analyst revisions over kind of a longer horizon up to 1 year, whereas the sentiment factors, or the new sentiment factors we're looking at, is more shorter term. And it's also interesting to note that the 2 new sentiment factors, ESS and CSS, have a fairly low correlation to each other, only around 0.23. So those 2 different sentiment scores are kind of picking up on different information. One of the first things you look at when you look at a new data set is the coverage. So this is kind of a 2 by 2. We have the old data set, RPNA 3.x, on the right, and the new one on the left. And on the top, we have the ESS scores. On the bottom, the CSS scores. And we did sort of a count of coverage at various aggregation windows, a day, a week, a month, and a quarter. And you can see that generally there's a quarterly news cycle. And that's very pronounced if you look at a day, a week, or a month, but it basically gets completely wiped out once you look at an aggregation window of a quarter or longer. And it also is very clear that the new data set does indeed have higher coverage than the old one, and the CSS scores generally have higher coverage than the ESS scores. So everything looks reasonable here. So let's get into our results that we found. So I mentioned at the start we wanted to kind of look at the degree to which any differences in performance are due to their additional news sources versus the improvements in their event detection and algorithm and so on. And so that's what we're looking at here. So we start with, in the gold performance curve, is our old data set, which has only Dow Jones news. Then we restrict the new data set to use only Dow Jones news. And so then we're looking at just the impact of the enhanced event and entity detection. And with the ESS score, we see that that impact is quite large, driving pretty much the majority of the improvement with the new data. But then over on the CSS score, we see a significant improvement in performance driven by the additional new sources. So pretty much in line with what we would expect. And the overall result being the new data set is providing significant value over our old one. We also looked at the impact of applying filters, as I mentioned, the relevance and novelty filters, more or less as suggested by Ravenpack and as seems intuitively reasonable. And we see significant improvements in the performance there as well. Just looking at what impact the filters have on the counts, so looking at the median number of news articles per company over a 1-month aggregation window, with comparing the old data set and the new data set with the various filters. So the new data set does not have 19,000 times as many news articles in it, only about 10 times as many as the old one. But when you filter it down, many of those additional news articles are somewhat duplicate or not novel or for individual companies, but then still we're using about almost 2 times as many news articles even after we apply all the filters. And we do look at sort of classical decile portfolios, univariate analysis as well, and in these we found that the new data set is fairly more well-behaved. The deciles are more monotonic with the deciles, and the filters are also making sort of the tails more extreme as well, which is good. Then looking at another dimension is the lookback window. So as one would probably expect, and as Peter showed earlier, kind of the shorter lookback windows, we tend to see higher factor returns, except in the case of the CSS score, 1 week and 1 month tended to be about equivalent, and we still do see some power at aggregation windows of a quarter. And looking at different types of signals, sum versus average, we see general outperformance of the simple average over the sum, at least in the US. Now we're going to take a look at another region, so Europe. For the analysis here, we're using basically the latest generation of European Barra model, which is very similar to the US FAST one. The factor structure is slightly different, but very similar. We got rid of the prospect factor on the long horizon factors and added 2 more, an ESG factor from our own ESG scores, and also an ex-Europe economic exposure factor that measures to what extent a company drives its revenue from countries outside of Europe. And also notable on the midterm horizon factors, we broke the sentiment factor into 2 parts, an analyst sentiment part and a news sentiment part. So when we conducted our cross-sectional regressions, we only replaced the news sentiment one with the news sentiment factor of interest. So it's also taking into account analyst sentiment. So let's take a look at what we see here. In comparing the old data set with the new one, in terms of factor return, the old data set actually generated slightly higher factor return, but if you look at an IR basis, the new data set has generally higher IR because the old one we achieved such a higher drawdown and higher volatility. And looking at the impact of filters again, basically very consistent with what we saw in the US. Adding those relevance and novelty filters did improve the performance of the basic signal on both the ESS and CSS scores. Then looking at the aggregation window in Europe, the results are fairly similar to what we saw in the US. Shorter horizons generated stronger factor return, but on an IR basis, the longer horizon still had juice left in it, particularly on the ESS signal. So in conclusion, we did find significant improvements with the new RPA 1.0 data set over our existing RPNA 3.x in coverage, of course. Also, it looks like their enhancements to the event detection algorithm and taxonomy really did improve the performance of the ESS-derived signals, and the addition of many more news sources drove the improved performance of the CSS type of signals. In general, the additional filtering on relevance and novelty did improve the performance of signals in general, and these results were quite consistent in the regions that we explored, the US and Europe. And so with that, I'll take questions, but one more thing. Armando, I think I changed my mind. I'd like my Ferrari in black instead of red.
Susan, take note. All right, thank you, George. We're going to be able to take one or two questions. So if you raise your hands, someone will bring a mic over. Got one up here.
Thank you, and thank you for your talk. I find it interesting that the objective you focused on is pretty much what Ravenpack probably focused on, namely average returns, whereas you work for a risk model provider. So I wonder if you also looked at efficacy in terms of risk prediction, or whether you think these two are equivalent.
So we don't really use factors for risk prediction. We use the factors to explain risk and attribute risk. And many of the factors in our risk models are, or at least some of them, are sort of classic risk factors that have high volatility and kind of low factor return, like size, beta, residual volatility, to some extent momentum and value. But then we've also expanded the factor set to include factors that are a little more alpha-like, so they tend to have lower volatility and more significant factor return. And we do that so that not so people can try to eat away their alpha, but so that people can better understand what their exposures are and what's driving their performance. So yes, there are many factors in the model, the traditional ones, and in the 10, 20 years ago Barra models, there were only 3 to 5 factors, the classic risk type ones. But as we've expanded, we're creating factors and including factors that are a little more alpha-like in nature, or higher IR type factors.
One more question here.
Great presentation, thank you. Just curious, you had the result about the sum versus average. Is that sort of the opposite of what, if you could just comment on that versus what Ravenpack had before? I think in the literature there's some other papers like that.
I don't think they're contradictory. I think so. If you look at the IR measures, I think they were quite similar. I guess I can't go back. Well, in terms of factor return, yeah, they were slightly different. The average was improved over the sum, but I think in the IR sense, they were quite similar.
Okay, thank you.
You have a question on Slido? Maybe Susan, you can read it out loud.
Yeah, so just one quick question. What are you most excited about in the next 1 to 5 years in this space, and what are you most concerned about?
Okay. What am I most excited about? Well, probably the same thing most everybody in this room is most excited about, is kind of explosion of data that we're able to access and incorporate and do things with. Well, data and technologies. So in addition to exploring alternative data, we're also looking at alternative algorithms, machine learning, and all that great stuff in doing things, not just creating factors, but doing other things that are of interest to risk modeling and generating portfolios and things. What am I most concerned with? probably data quality. As was pointed out by others, some of the new providers may not be as well aware of stuff like look-ahead bias and how they process their data and making it consistent over time and regenerating history and not accounting for survivorship bias and things that is all second nature to us, but some of the newer providers may not be as well aware of. So in terms of data quality, that's something that I worry about.
This is Raven Pack.